the material that I prepare here is really for people from the shipping industries, and that they are not familiar with the futures trading. So the language I use and also the kind of details I provide are really for the non-futures expert. So I start here from some basics about the futures market for the container freight. It is not new. It happens. I heard one of my senior in MERS told me that they also have tried to put together a future products in year 2005, 6. But then that one probably did not take off. So then another attempt was around the time the dry bulk and tankers start to adopt the FFA trading. So there's a fixed forward agreement. In Shanghai, they have these things under the Shanghai Shipping Freight Exchange. Yeah, freight exchange was that is the trading period is from 2011 to 2016. So I just put it together, so the entire trading records in terms of the daily turnover from 2011. So which is, I mean, I put it in the same chart, but there are two different products. This is one so under the companies, which is found under the Shanghai Shipping Exchange. So the party that issued the container freight indexes in Shanghai. So they have this company called Shanghai Shipping Freight Exchange, that they have this thing called container shipping derivatives. So because they are not properly regulated exchange in China, so they cannot call it futures. So in fact, this one's more like a futures because it's a chain here. It's a digitally trade and standardized. So it's not a trade. Because Ford usually is referring to the future products or the derivatives that is actually trade over the counter. So, but back then, in Shanghai, this one looked more like a futures. So there's a liquidity back then. Of course, comparing to all the other container freight derivatives, this one still looks decent liquidity because at the peaks, it gone up to over $100 million a day. So, but then obviously, that liquidity hasn't been sustainable. So the main problems, one is the product design, but a bigger issue that then they face is it's a single product exchange. So they don't really have an existing ecosystem of members, which the futures broker and also the traders around that they are trading many other things. So because currently now in INE, Shanghai International Energy Exchange, in this exchange, I'll show you a bit later. They have oil products, they have copper, they have some chemical products, rubber, and then their sister companies, Shanghai Future Exchange, have even more product. So although you see that daily liquidity in the container freight in these rounds and in this product, a couple billions, and then even up to 7 billion at the peak. But then I'll show you in a moment. This liquidity is still a small drop in the oceans for the exchange. That is a derivatives being listed. So this round they have the ecosystem. My point is the last times they don't really have the ecosystem to sustain it. Then of course they're also not a properly regulated exchange. That might be it's kind of chicken and egg. When you're not regulated, maybe you cannot track all the potential traders and also brokers that come to your market. So you can see I mean that is the last time, and this is some totally different product. And there's also a couple of years ago the collaboration between Frictos and Baltic Exchange. They also have a CFFA, and that one's trade over the counter. And then so they cross properties as a forward contract. So obviously that one's also trade over the counters. They are not digitally matched, like the product that we have just shown you. So you need to call a broker, and then the broker need to find a buyer if you want to sell, or you need to find a seller if you want to buy. So you have to trade through a human broker. So that is a different product than the INE here. So, but that CFFA, they don't really have a noticeable volume, put it this way. So although recently we heard the good news that they have a container line that just put through a train through them, but the volume wasn't disclosed as far as that I could find in the public information. So it's a bit of story, so it's not new, but this time it's totally different. Once the liquidity is different market. And then also, so okay, a point worth pointing out is last time in Shanghai they had this derivatives that wasn't open to foreigners, but this time they list in exchange. So this Shanghai International Energy Exchange is actually outward facing, so they allow the offshore money to go through like what we do is a war fee or Q fees, like different channel to go into this market and trade it. So this market, this round, this product is open for the offshore money. And then next one's about the instruments. Yeah, we talked about it many times, but it's mainly to show you since its launch in August last year. So far, it has now we have 6 products here from June until April next year. But it was also another contract that's expired in April, so that has been cleared and settled 2 months ago. And then basically we report these charts about the daily price of all these contracts, but then all these contracts actually suggesting the settlement or market's perception of freight rates to be the going rate in different periods. So like the August, so like June contract is what the market expecting this month's freight rate would be, and then August is what the market's expectation of the August freight rate. So that hangs about the name of futures. And then below it is some of the key indicators about the sentiment, and then I mean the conviction and also the trading sentiment of those instruments. So I put them as an aggregate for all the product, all the contract together. So the lighter colors are the turnover, which is the US dollars value of a contract being traded per day, and then the darker colors are open interest. The difference between the turnover and the open interest is so the turnovers, you could have a lot of traders open position, long or short, and close in the same day. So a lot of day trading volumes, as they may be called. So, and then the darker colors, the position that the traders sit overnight. So they don't close before the market closes. So it's actually kind of if a trader willing to take a position and sit on it for a longer period, it's kind of a signal of the conviction of the market. So we see that usually in the futures market, we look at the ratio between the turnover and the open interest. It's kind of a signal about how speculative the market is. Usually in the stock markets, the ratios are below 1, but we can see that in the INE and also in the Shanghai Futures Exchange. So I think on average, their turnover to the OI interest, open interest, ratios about 1 or about 1. So it is fairly, put it this way, that is a fairly speculative market. But then you could also see the market kind of mature. So at the beginning, you have far more turnover than open interest, and gradually you could see more traders. They probably have done more research and also become more willing to get the overnight position. So you can see the ratio between the trading volume and the open interest. They're kind of assuming into kind of more about the ratio 1. So which is more or less the entire the Shanghai Futures Exchange market average. And then this one is to show you why is for these future products in the industry now. We have some probably onshore that there are some small fixed orders or medium-sized fixed orders that have tried it, but a lot of international players like the liners, big importer in US and Europe, mainly Europe, right? So because this contract is only for the Asia-Europe trade, and also the forwarders. They're not in it yet. One of the bigger questions they have about if they should try or spend time on it is whether this liquidity is sustainable. So of course, if the liquidity is not sustainable, so if they spend time on it, eventually they will lose it. So, but if we, hence I show you this data here. So the entire market, including the Shanghai Futures Exchange and the International Energy Exchange. So in May, they have a daily turnover of 138 billion. So of course, it's a growth. In future market, we know the convention, people use the number of contracts to measure it. And also, for those 138 billion, you should heard what Vince mentioned about the margin trading. So a lot of traders not really taking that much money to exercise those trades. Then they put in a fraction by the margin, so they probably put in 10% of the equivalent of this total gross value to the trading. But anyhow, because the risk is actually measured in growth. Although you borrow money, you put much less money in. But I tend to look at the size of the risk that the entire market is taking. So for the ECs, the European contract, or what we call the coffee, the 2 billion a day trading volume is actually a small percentage for the entire market. So it's kind of a go to show that it's actually more likely than not they will continuously have that level of speculative interest in this instrument. So no moral judgment, because when you talk about speculative interest from the shipping industry, they tend to look at it in a very negative way. But I mean, in capital market, stock market actually is mostly speculative. You don't see stock market people buying and trade the stock for the control of the company. So, and you see that the speculative interest will last for a long time. So there's always people or investors looking for capital gain. So hence you have this kind of trading volume. So this speculative interest in the liquidities is what allow the industry to use. Without it, you can't really go in there to try to do any kind of hedge. So that is really a point to convey about the total liquidity of the market. So just in the exchange, not including the stock market in Shanghai, or also the Zhangzhou exchange. There's another future exchange on the Berlin exchange. Just the Shanghai Future Exchange and the INE itself, so they have this one. And then these ones, the points we mentioned it many times about just different way we look at it. So when we trade it, we need to understand about what we are trading. So the underlying of a coffee is basically this thing called SCFIS. We talked about it last time, so we are quite familiar with SCFI, which is the lighter color here, this one. And then the black thick colors line is the SCFIS. So SCFIS is it only exists since May 2020. So basically at the beginning of the COVID. And then the SCFI exists since year 2009. The two relations is SCFI is based on the input from a panel of container liner, freight forwarder. Every week they give some input to Shanghai Shipping Exchange about what kind of quotation they're giving to the spot shipment. So that's what make up the SCFI. And then the SCFIS is based on what has been shipped, and then the declaration, the freight rate declaration on the bill of lading. So the relation between it is this SCFI is leading a couple of weeks because it's talking about the freight rate for the next couple of weeks. And then SCFIS is the actual freight rate that has been earned last week. So there's a bit of time lag difference. The correlation is very high, but so I have to also show you that their relationship is not linear though. So they are not even constant. So over time they really have fluctuation, but they don't also don't show a clear trend about I mean, if there's really two of the same things, like with the fluctuation, they may still have a kind of a line, but you can see that they have a range actually between 1 to 0.7, so it's pretty large range in the two. So that because SCFI is US dollar per 20 footer. So although on their website, the Shanghai Shipping Exchange, they say it's a US dollar per TEU, but it is not a branded average of 20 footer rate and 40 footer rate. It's really only for the 20 footer rate. That's SCFI or the European index. So I mean the Asia to Europe, Shanghai to North Europe index. So but then the black one, the SCFIS, is a branded average. I'll go to the formula in a moment. So a branded average of a 20 footer rate and a 40 footer rate. Hence, they are not really, they don't really give you a linear relations here. So that's another way to present it in this chart here. So it's about SCFI and SCFIS are put them together. So and then we put the future in the as a projection because the future is we are talking about the freight rate, talking about the future contract expiring in June is about the June freight rate, August freight rate, October freight rate. So we put them together to form a line to allow you to see the relations between what the future market is trading as comparing to the historical freight rate in the chart. And then, yeah, underlining a bit more color on the underlinings. I mentioned about the SCFIS, we come with a formula, so it's mainly this one. So it's a 20% rating for the 20 footer rate, the FAK rate, and then the 80% rating for the 40 footer rate. So most of us in shipping, we know that we are not paying twice of a 20 footer rate for a 40 footer rate. Usually, the ratio, as I shown here, which I get based on the spot rate quotation from the liners over time. So my overtime since January this year, it is a range between 1.35 to close to 1.7. So that, I mean, okay, sorry. So here's the 40 footer to the SFIS. But if we're comparing the 20 footer to the 40 footer, they also come in a ratios. They range between about 1.5 to 1.7. Sorry, I'm misled. This ratio here is not about 20 to 40 footer. So I don't have the chart here, but 20 to 40 footer ratio is a 40 footer is about 1.5 to 1.7 times of 20 footer, depending on when the 40 footer equipment is more in shortage relative to the 20 footer. So when the 40 footer is more in demand and have less supply, so the 40 to 20 ratio can be higher. So, but anyways, if I take, I mean, this equation here is what, because the relation between 20 and 40 is not linear, it's not constant. So it makes it very difficult. Just you taking the SCFIS to try to figure out what actually is the market going rate that it represents for a 40 footer or 20 footer. So I compared the 40 footer market going rate that I get from the spot market to the SCFIS. So I couldn't get a linear relation. So it has a range here. So hence, when we trade the SCFIS, we have to bear in mind that although the correlation of the SCFIS to the spot freight rates is very high, but the translation to a 20 footer and 40 footer rate is not very clear at this point. And then I show here, I mean, the routes the same, Shanghai and North Europe. Okay, I want to also to explain this. So all the Shanghai to North Europe here, what we mean is from Shanghai to North Europe, so 4 or 5 base port. One is Rotterdam, Antwerp, we have Felixstowe and Hamburg. There's 5 European base port. So which is the same for SCFIS and SCFI. But then the unit between them are different. And then the market convention, you tend to actually use dollar to 40 footer. So all three come in a different unit, as you see here. So hence a bit of complexity for this instrument. And then here I just illustrate about how different it could be. So taking, like, let's say the closing rate of the August contract. on 27 May, it closed at 4313. If you take the 1.37 ratio to try to figure out what it represents in the forfeiture rate, then you get below 6,000. But then you take a higher range of the ratio that they happened over the last few months. So that's close to 1.7, then you get over 7,000. So the range is higher. But however, so when we don't have an exact 40-footer rate number, but when 40-footer rate go up, this SFIS will also go up. So hence the high correlation between it. And then, so here's we talk a little bit about the nitty-gritty about the numbers of when you trade it. So once in this EC contracts or what we call the coffee, they are traded in a multiple of 50 RMB, meaning whatever you see in the index here, when you buy one lot, then you have to multiply with 50. So you buy on the 27 May, closing price is a 4313. So you buy the minimum that you buy one lot is actually close to 200, so over 200,000 RMB. So that's what you are buying. So then, of course, we talk about how we relate this one lot to the actual physical market, meaning in the shipping market is depending on the ratio that you assume about the SDFI to the 40-footer rate. If you take the 1.4, 1.37, so then it's one lot of coffees is nearly equivalent to 5 40-footer. Or you take the higher end of the ratio, then it's about 4 40-footer. So, and then it's about, we talk about, Vincent talked about the margin call or traders could use a fraction of the money, the total value of the contract to buy and sell this contract. So yes, this is the exact example here. Like one lot, although is the total value is over 200,000 RMB, but at the moment, exchange allow trader to trade on a margin of 18%. So the margin is a minimal deposit that you have to put down to buy or short this contract. So then the money that you need to have to exercise this trade, instead of over 200,000, you can actually just put in less than 40,000 RMB to trade it. So unlike the stock markets, when we short sell a stock, so we actually get the cash back. But in future market, so to long or short, I mean at least in this INE's future market, so to long or short, so you need to actually put in money. So to short, you don't get some cash back as short selling some stock. So the short selling stocks are just to explain a little bit for most of our shipping peers. So short selling is about like let's say I don't have Nvidia stocks in my portfolios, but I want to short sell it. Then I will go to my broker, borrow one lot of Nvidia, and then let's say one stock on Nvidia is over 1,000, and then I sell it to the market. Then I will get nearly $1,000 back to my account. But then I owe my broker there's one Nvidia stock, so at some point I need to return it. But in terms of cash flows, when I short sell, I actually get the $1,000 back. But short selling in future market for coffee or for this EC contract, so you have to put in cash. So long and short, you need to put in the minimal deposit to exercise it. And for short selling, you don't get the money back. So let's talk a little bit, illustrate a bit of the impact of trading on margin, meaning only use the minimal capital required to exercise a trade. So of course, for a gross value of over 200,000, you put in only $40,000 worth of value to trade it. If we go limit up, like let's say now, one point to note also, the minimal margin and also those trading limit, meaning that the maximum amount of molecules a future contract to go up or down in a day, this is what we call the limit, the trading limit. So decided by the exchange. and they change them with a couple of days notice. That's how that works in INE here. Which also when you trade those things and manage your portfolio, so you also need to bear in mind the margin requirement tend to go up when they see the market is being overly bullish, very speculative, and then also the trading limits. Sometimes they will also extend if they see that the contract itself, the price is actually very different from the physical market. So those are the things that we need to bear in mind. So there's the margin and limits could be changed from time to time. So anyway, back to this example here, the margin 18%, the limit 16%. So if you go limits up for 1 day, well, if you go long, then of course it's very good, right? For 16%, that means like 30,000. So if you trade on margin, then that means you go from less than 40,000 RMB to become 70,000 just in 1 day. Then you get 85% return. So that's what we mean by leverage. The underlying up by 16%, but because the leverage, then you get much bigger return than the actual contract because you're leveraged. So, but then of course, if you go down, only 16% move, it could actually linearly write off all your entire value. Also, it's 89% down. So that's the risk of the margin. I talk about margin call in the next one. So what's the situation here? So we have seen it in January. You can go back to this contract back then in January. I think the main contract is the April contract. So when the markets are bullish, so you can go multiple days and limit up. So what limit up means? Limit up means so the market quickly move up. Like let's say the trading limit up is 16%. So the market could quickly actually realize it's 16% up in terms of price move shortly after the market open. So once it reaches the limit, the trading will be stopped. So we have seen some multiple days in January, just in a few minutes, or as soon as the market opens, the contract reaches limit up, so you cannot trade anymore. So if you are making money, of course, limit up doesn't matter. So whatever 16% up, then you are returned just a multiple, the 16% up for your margin trade, or for your margin trade, or for your leverage. But if the market go against you, so a couple of days of limit down, you could totally write out the 40,000 that you have put into trade is a 200,000 worth of contract. So if it's below it, it gone negative. The broker, in reality, will call you to ask you to close some position. But in the bench cups games, the algo is simply to close some of your loss-making position to make sure you have a sufficient cash. So in your, at least you can meet the minimum margin. So my bearing. So when the market is very speculative, the exchange can increase the margin. If the instrument go against you, you go long, and then the contract drops a limit down a couple of days, and then at the same time the exchange increase the margin, then you could quickly hit your margin call limits. Then those are the situations. In reality, it's very inconvenient. So that's a part that for futures trading, that's kind of a risk management that we need to manage. So okay, and then we talk about the settlements many our shipping peers ask me, oh, do we get, like, let's say if I'm long a contract, do I get a shipping slot in the end? No, you don't. So if you long, like let's say you long this August contract, based on this 4,300 price. So if on the closing, in August, when the market price pushed SCFIS up to 6,000, then you make money. But then the money that you make is actually also settled on margin. So meaning is the ending price minus your entry, and then multiplied with 50. and then minus the deposit you put in, that's a profit that you make. Or your total money that you get back is goes to 80,000 here. So basically it's a 45 plus this 39,000 RMB. So there's the money that you get back. So the profit that you get is the 45,000, but you don't get a shipping slot. So if you long a contract, that usually is in a hedging situation, which we'll talk about in the next seminar. So is that you long the coffee, so typically you probably have an index-linked contract with the liner, meaning your relationship with the liners is a fixed. You'll get a space from the liner, but the liner is unable to or unwilling to commit a price to you. Hence, you go to the coffee market to fix it by longing it. So then you fix a price there, and then on the other hand, your relationship, the index-linked contract that you have entered into between you and the liner allow you to still to get a space. So that's how it works. So you go to the coffee market to long, it doesn't mean that you get a slot. As a forwarder or liner, you go to the coffee market to short sell it, doesn't mean that you don't need a cargo to fill your slot. Because the money you get is only the difference, or you get the profit, but the profit is still a small fraction of the total 6,000 that you will need to earn or you need to pay in the physical market. So we will get a bit more into the detail. But the slide here, you can really it's more about just going through the math about your total exposure, and then if the price go up 6,000, then what's the money that you make, and then the return that you enjoy. Or if the market go down, then the 4,000, how to actually calculate of this P&L for your contract. And then the next one here is just like highlight a few points, but in various different places, also in the demos we have talked about it. So about the advantage of the markets, about the liquidity, to allow you to make trade without pushing the price. So basically for the kind of liquidity they have in the INE for this coffee, so most of the liners and most of the forwarder BCO can cover their entire month's open slot or so the shipping slot requirements in a couple of days, basically. Because at this stage in May, for example, the daily turnover is close to $2 billion a day. So it's many. We cover a lot of. So we're talking about hundreds of thousands of people. So and then digitally trade. So entire trading experience is basically the same as what we trade the stocks on an interactive broker or different the brokerage app. And then the counterparty risk, the products are created by exchange. So just like trading stock, you don't need to worry about who actually is your counterparty, who will trade against you in this market. So and pricing is based on SCFIS, and then that's based on a very large pool of volume of shipment that actually happened. And then the market is the INE is a kind of a bond marketplace. So where you can offshore money can go into, it's free to convert to RMB and convert back to US dollars, and also it's not subject to the local taxation. So a few more slides to wrap it up quickly. About some of the data points that we follow, which for the contestant here, we will launch a kind of coffee specific product, mainly for the Asia-Europe trade. So we track the utilization. That's the most recent ones, the one that we just recently published. So one of the big change here is you can clearly see the market currency. The utilization is actually much higher than the track record over the last 2 years. So one thing is the top, the extremely heavily loaded vessels utilization don't change much, but the lower end actually is moving up. So the lower end usually the independent operator. And then we see that the capacity here is recently, we have seen some peak capacity. And we see that in June, a couple of weeks is extremely high. But if you look at the 4 weeks moving average, this one is 285,000 TEU per week. So about the 4-week moving average for the past 4 weeks. Comparing to the same week 21, in year 2023, actually year-on-year basis is still low. So that goes back to the point that we mentioned in the last webinar. Despite more additional capacity being deployed in the Asian year trade, but the effective capacity is measured in the weekly capacity level. That on a year-on-year basis, we haven't seen much of capacity growth. So despite of the volume hasn't been really spectacular, so it's just a seasonal pickup, but because the capacity didn't grow, so then we have a high utilization. So there's another chart for utilization and capacity. So we do have data that can break down to different operators over the years and break down to different alliances, so like 2M, Ocean, and the Alliance. So I quickly go to. So we also have some kind of a detailed data that you can look at. So we will put this one to share for the friends, clubs, and contestants. So you can look at this set of data tonight and tomorrow. You're welcome to come back and ask questions. So lighter color here is the one who depart. This one's the last week. So the one who's supposed to leave last week, so you can see that out of the 12 sailings, there's still a 4 ships that still haven't left Far East. These two for the evergreens, they are still in China. So I think they are affected by the congestion in Qingdao. So and then the 2 MSC vessels are affected by the congestion in the Tianjin Palace. And then I'll put down about what are the last Asian port that they call here. So it's all Tianjin Palace and also the Shanghai, the East Chinese ports that is servicing. So you can look at it yourselves. I've just go quickly with it. I think I mentioned it. Those are the summaries. You can also look at basically it's corresponding to the week number here. Then from week 21 to week 26. So the number of sailing per week, some of them long alliance sailings, and then the TEU, and then the 4 weeks moving average year-on-year growth. So you can see that despite the week 24 and 25, so the capacity will have a big jump, but on a year-on-year basis, those are not really out of this world size of capacity. Last year we've seen even bigger capacities for those weeks. So these 2 weeks are basically end of June, mid-June, end of June, and usually the beginning of a peak season for Asia year. And then a bit of this only set of data, so that's really not proprietary to us. It's from hit rate. So since the last webinars, for Ocean, the Alliance, they're more or less holding the peak. Unchanged. So like once there's 8,000 for 40-footer coal. And then THE, so the Ocean Alliance, is a member similarly as the last webinar, but MSC started coal high, coal up to 7,000 for 40-footer, 7,500. So those are the main delta here since last week.